Welcome to the last session of Foundation Accounting and Finance. In this session, we are going to talk about the dividends and other payouts. Why is dividend important? Why is the dividend decision going to be very important for a company? Is dividend decision important for a company? What are the different kinds of dividends that a company can pay out? And so on and so forth out there. We are going to spend maximum about 20 minutes, 25 minutes out there. And with that, we come to the end of this course itself. Now, move on. I am just going to have some slides out there. Dividends can be of multiple types. One is regular cash dividend out there. Second is stock dividends. Third is stock splits. Fourth is stock repurchase. Sir, dividend means cash, not this. These are different forms. What is stock dividend? Typically, your bonus share is stock dividends. I am going to take some time in explaining this. Now, different types of payouts. Dividends, cash distribution to earnings. Liquidating dividend, distribution from capital as a liquidating dividend out there. Now, let us not worry about that. Let us worry about these three. A company pays dividends. When company pays dividends, that means there is a cash, that is they pay cash dividends. That means there is a cash outflow from the company issues money to the stockholders, gives money to the stockholders, whatever is the percentage, 10%, 20%, 100%, 200%, whatever is the percentage out there, they issue money to the stockholders and the stockholders get their money. And that is all what happens. The stockholders will get the money in their hands, they have to pay tax on the dividends, and that is it. That is what we call it as regular dividend. The next aspect when we talk about is nothing but what we call it as stock dividends, or typically the other way to use it is what we call it as the bonus shares out there. The question is, what is this bonus share? How is this bonus share issued? Let us look at the capital. Let us look at a company out there. Let us look at a company's balance sheet out here. Liability plus equity. Let us say the company has 10,000 shares at 10 rupees each. Now, that is about 1 lakh out there. This is equity. The company has reserves and surplus, and one of the reserves and surplus, the retained earnings, there are various aspects. Retained earnings in the company in the first year is only about 30,000. Second year, this retained earning increases, it is not 30 anymore, it is, let us say, it is 60,000. Third year it increases further, it is not 60 anymore, it becomes what do you call it as, it becomes about 1,30,000. Fourth year it is not even 1,30,000, it increases further, they say it is about 2,10,000. Fifth year it is not even 2,10,000, it increases to 3,20,000. 3,20,000, it increases to what do you call it as, 3,20,000 on that. Let us say this is in the fifth year. So, what is the total capital? Total capital is 1 lakh plus 3,23,000, it is about 4,20,000 is the total capital or net worth of the company. To whom does this net retained earning belong? The retained earning belongs to these equity shareholders. The retained earnings belongs to the equity shareholders. I have to give it back to them. I am not giving any dividends in the company. I am retaining all the money that company is earning and just building it, reinvesting. Now I decide I want to give some kind of return to the shareholders out there. I don't want cash outflow from my company. I want to give. Then what do? I give stock dividends. What do I do in that particular case? I will say in that particular case I am going to drop the revised balance sheet here. I have 10,000 shares of 10 rupees each, 1 lakh. Now I am going to say for every 1 share you are holding, I am going to give you 2 more shares out there. I am going to give you 2 more shares. I am going to give you the 2 more shares. You don't have to pay for it. I will take the money that is there in the retained earnings under your name and take care of that. 2 more shares I am giving you. 2:1 is the bonus share I am giving you. 2:1 is the bonus I am giving you. 2 shares bonus. But how do I get the 10 rupees per share, 20 rupees from you? You don't have to repay me cash. Your money is there in the form of retained earnings. I will collect it from there. So what happens? Now the number of shares is 10,000. I am giving 2 shares for every 1 share held. So it becomes 30,000 shares of 10 rupees each, and the capital becomes 3 lakhs out there. Now what happens? My retained earning after the bonus issue is only about 1,20,000 out there, because 2 lakhs from that has gone to the equity out there. It's still, the company's value is still 4,20,000 out there. Value is still 4,20,000 out there. So what is happening? I have given the form of bonus share. I have taken out of the retained earnings and given it to the equity holders out there, and that is what as far as the company is concerned, there is no cash outflow that has happened, all other than issuing the cost of issue out there. That is all that has happened, and this is what we call it as the bonus share, or we call it as stock dividend. We call it as the stock dividend in this particular case out there. This is what we call it as stock dividends out here, and that is what you see in this particular case. No cash leaves the firm. The firm increases the number of shares outstanding and reducing the value of each share. That is the ratio. That's all. Next, the company can go in for a stock split. Now, how can stock split increase the value? Let's come back to it. Let's go back again. Let's go back to my whiteboard out there. Let's take a company X. Has 10,000 shares at $10 each. Market price around 6,000 rupees each. Beyond which it is not moving. Why it is not moving? Because no liquidity. No transactions, no liquidity. Then what happens? But you feel, you are very sure, you know that the value of a share is not 6,000, the value of the share is somewhere around 7,500 out there, or 8,500. Let us not even keep it 7,500, let us keep it 9,000 out there. The value of the share is 9,000, but it's getting stuck at 6,000. It is getting stuck at 6,000 out there. Why it is getting stuck at 6,000? Because liquidity is not there. Not much of transaction is taking place on the stock, because only 10,000 shares are there in the market. Not many people are able to buy and sell. But I know it is worth 9,000. So what do? I go in for a stock split. So what do? The 10,000 shares, I will say 20,000 shares at 5 rupees each. So theoretically what should happen? The price of the share should become 3,000 rupees each, because the 10 rupee share was at 6,000, a 5 rupee share is at 3,000. But what happens in reality? Liquidity increases, 20,000 shares are floating in the market. Lot of buying and selling will take place. So what happens? This price will keep moving up, and it will somewhere settle at about 4,500. It will settle. The market will settle, because after some time, because too many shares are there, liquidity is addressed out there, and the value. So what happens? As far as the shareholder is concerned, I had 1 share, now that share has become 2 shares, and the total value is 9,000, and I basically got some money with me in it. I can encash it, I need not encash it out there. I need not encash it, no problem. But the company, as far as the company is concerned, the company has gone in for a stock split and has given me dividends out there. There can be a stock repurchase. The companies can adopt repurchase. The price is not moving up in the market. I can buy back the shares from the public at a particular price out there, at a particular predetermined price out there. So, well, that also can happen, and that is what we talk about as repurchase. So, the dividends can be in multiple forms. Standard dividend cash dividend method, decision by the board. Amount of dividend is expressed in dollars per share, dividends per share. Percentage of the market price is what we call it as dividend yield. Percentage of the EPS is what we call it as a dividend payout out there. There are 4 different days which are, I have given some examples from the textbook out there. There is a dividend declaration date, there is a ex-dividend date, there is a record date and the payment date out there. That is any transaction that happens before or during at the ex-dividend date out there, before the record at the ex-dividend date, the purchaser of the share will get the dividend. Any transaction that happens after the ex-dividend date, the seller of the share will retain the dividend. So, what happens? At the ex-dividend date, the price will fall by the amount of dividend that is declared as far as the company is concerned out there. Date of record and what do you call it as ex-dividend, and I have given some details of all these explanations out here in this particular case. Now, having said this, I am going to go into one more aspect out there. This is the price behavior. That is what we saw. I have just said that at the dividend out here, X date, at the X date, the price will drop by the dividend, and that is what will happen. I have just explained it in the form of a graph out there. Individual purchasing security before X dividend date will receive current dividend. Individual purchasing security on or after the date will not receive the dividend, whereas the seller will receive dividend. Stock price will therefore fall by the fall on the ex-dividend date, and prices drop also depend on the taxes that are applicable in the dividend and so on and so forth. Now, I am going to talk about repurchase. Repurchase can happen in open market route, in a tender route, Dutch auction, targeted repurchase. Let us not even get into that. I will say normally open offer or a tender offer, open market purchase or a tender offer. In a tender offer, the firm announces all its stockholders that it is willing to buy a fixed number of shares at a specified price. In an open market, anyone would buy the share of a particular stock out there. They can have targeted repurchase. I want to buy from a block holder. I want to buy from HNI who is holding. I want to buy from somebody who is holding a certain amount, a certain percentage of stake out there. Yes. Now, why is dividend so important? There are some more slides out here. I will go through some more of these slides. Why are dividends so important? The dividend policy is extremely important for a company out there. Why is dividend policy extremely important for a company out there? Now, let us look at how does growth happen in a firm out there. How does growth happen? For a company which has reached a steady state, I think my writing is very poor. Let me rewrite the whole thing. How does growth happen? That is all. Very simple question. For a company which has reached a steady state, which has surpassed the supernormal growth, which has reached a maturity stage, which has matured, how does growth happen? Growth happens because of reinvestment that happens. Growth happens because of investment that you make out. Investment means I can't keep constantly borrowing and investing. Then there is a cost of borrowing. I can't keep on issuing equity shares and keep on investing out there. Then there is a cost of equity out. Now, growth happens. One of the reasons growth also depends on what is called as your dividend policy. Now, what is the dividend policy? We will say dividend payout ratio. Supposing the firm earns X amount as what you call it as the net income or PAT, and the company has a policy of paying 40% as dividend and 60% it retains, called as retention ratio. Called retention ratio. What is called as retention ratio? Then what is happening? Theoretically, in the balance sheet, there is an equity capital and retained earnings will increase by that 60% out there. So, what is happening? Your investment is increasing by the retention ratio. So, what is happening? Your capital is increasing by the retention ratio. When capital is increasing at the retention ratio and your company has a certain return on capital employed, your company has a Y percentage of return on capital employed, then this 60% what you have retained will also earn that Y percent of return out there. So, growth will be equal to retention ratio into the return on equity. In this particular case, I would say return on equity out there, because this 60% what you are retaining, you are accumulating is getting reinvested, and that is going to earn a return, and that is basically earning a return at the rate of at the return on equity part of it out there. So, when we say growth is nothing but depends on retention ratio and return on equity out there, because that is where growth comes in. Why? Because let us take an example. My company gets 10% return on equity. My capital is 1000 now. My capital is 1000. That means my return is going to be 10 rupees. I am retaining 60% of it retention. Rest of it I am giving as dividend. That means in the second year the capital will be $1006 out there. My return is 10%. So, what am I going to get? I am going to get about 10% of 6 is what? 60. So, 10.60 is what I am going to earn out there. Am I right? So, what is happening? There is a growth of 0.6 out there is what is called as the growth. That growth comes in why? This growth has come in because of the $6 that you have retained. That is all. So, in that sense, dividend policy becomes an important attribute. Dividend policy becomes an important attribute to determining the growth, the retention ratio, the growth, etc., etc. of the firm out there. I have got some basic things out here. Dividend versus repurchase, real world considerations. There are dividends will give you what is called as repurchase out there. It gives dividend is a fixed commitment, and it sort of is a permanent increase in the cash flow, increase in its dividend out there. Shareholders, flexibility for a shareholder. Repurchase is temporary. Every year you can't do the repurchase, because every year you do your repurchase you will completely exhaust. So, what happens? Dividends are almost consistent out there. Repurchase is not consistent. Executive compensation, frequently given stock options as part of their overall compensation. So, dividends is better. It offsets dilution, and of course, repurchase, the only advantage is provides some tax advantages over the dividends out there, because you will get into the capital gain taxes, which is in India it is relatively lower than your slab, as a relatively lower slab than your income tax slab and everything, IT personal tax slab and everything. Personal tax dividends, I am not getting into this part of it. It's basically both cash dividends, capital dividends are currently taxed out there. So, let us not get into this part of it. I am getting into the real world factors favoring high dividend. First, desire for current income. So, personal taxes for it. So, beyond this we move into what is called as dividends. Can it be used as signaling? Yes, it can be used as signaling. Market reads the signals which the company is sending out. If the company is distributing a lot of dividends, seen as a positive, sometimes seen as a negative because it has no investment options available. It is basically one of the signaling aspects that can be used out there. You can spend some time reading this slide out. Increase in dividends is obtained by only reduction in capex because you do not have avenues to invest, that is where you are increasing the dividend. At some point, the market will learn that cash flows has not increased, but instead profitable capex has been cut out there. That means cash flows are not increasing greatly and your capex that you can make, you are basically cutting down on the capex and giving the dividend because dividend is a cash outflow. So, it is a signal how you read it out there. There are pros and cons of dividends. This is I have just picked it up from the textbook. The slide is available for you to read. I am not going to spend time on reading the slides out there. And the last one, bonus shares on stock dividends out there. This is, as I said, additional to shares of stock instead of cash, increase the number of outstanding out there, shares out there, and commonly expressed as a percentage out. I have given an example in this case. Stock splits also are basically explained in this particular case. Stock splits also done. So, why is dividend important? Dividend policy is extremely important because your dividend policy will determine what is the retention ratio that you are going to have. Retention ratio is going to determine what is the kind of growth you are going to have. Growth is going to determine how the company is going to perform in future. Thank you. With this, I end my course on foundations in accounting and finance. I hope lectures were value adding for the viewers, those who have viewed. I also have live sessions every 2 weeks so that you can, if you have questions and doubts, you can always interact with me and get the questions and doubts clarified. The objective of this course was to generally give a basic foundation in accounting and finance. It is not making you an expert, that is not the objective of the course, to just basically give you a foundations in accounting and finance, basic foundation, so that you are not allergic to the terminologies, you are comfortable talking about or reading about accounting and finance. I hope the course did add value to all of you. Well, if it is not, you can also send me the suggestions. I will only be too happy to incorporate and re-edit the videos out. Thank you very much.